Tech trade seeing its worst start to the year since 2022, with the Magnificent Seven cohort down 16% year to date. A tough start to the year coming after the group rallied 67% last year. Joining us now on what to expect for the sector going into the second quarter, Dave Mazza, Roundhill Investments CEO. Dave, it is fantastic to see you this morning. Thanks for being up bright and early for us. So as we look at the Mag 7, really it's been split among the strategists that we've spoken to as to whether they are still sort of all in on big tech or taking a step back. How are you thinking about it, since this has really seemed to be the risk aversion barometer that has been very sensitive this year thus far?
Yeah, we know the Magnificent Seven stocks have been the market generals now for some time. And sort of when the generals are wounded, it's hard for the rest of the market. It's hard for the soldiers to really carry the torch forward. And one of the reasons why we're seeing sort of this bifurcation of, to your point, folks remaining pretty bullish on this group and pounding the table that this is a great buying opportunity, and those that are really getting extra cautious, is just due to the amount of unprecedented uncertainty that we're seeing. Just look over the weekend. We're now, the Wall Street Journal is reporting that there could be 20% tariffs, 20% tariff rate across the board, something much more aggressive than I think even sort of cautious investors and traders were pricing in even on Friday. So the rate of information that we're having just about things that investors and companies themselves can't control is growing, and that has made it sort of a difficult environment to navigate.
It's certainly difficult, but we are going to ask you how you're navigating it, Dave. Where are you finding opportunity right now? And is any of the dip looking attractive to you? Are there any areas even within tech that you're buying right now?
Yeah, so it's interesting. So we're seeing this disconnect between hard data and then soft data. So by soft data, I mean surveys, and particularly the consumer surveys, have really fallen off a cliff. But to date, hard data, so employment, inflation, have not rolled over, are not necessarily bad. Earnings, of course, last quarter were pretty strong. I think I actually expect to see some strong earnings again, especially out of the tech side in the upcoming earnings season. But right now, we're very cautious. So I think boring is better in the very short term if we're sticking with the U.S. So staples and utilities come to mind. Of course, we know they've held up a bit better, because what we're seeing is just sort of a wave of sort of weaker hands. Some of that is sort of momentum investors, whether that's retail investors or hedge funds, who is selling very aggressively. But at the same time, and we're seeing this with our ETFs, there's still sort of a bid in the markets. So people are still allocating to equities, but they're doing so while the share price continues to decline at large. So at some point, that certainly could stop. But again, better is boring for the very short term. But I do think there's going to be some opportunities for sort of those high quality Magnificent Seven names as we get into earnings season, and they can again prove that they're the areas where there's growth coming from, not other places in the equity market.
Dave, what about tech outside of the U.S.? Speaking about China, big tech in particular, I know that the CoreWeave, which is an ETF that tracks China tech, has pulled back a little bit. But is that an area perhaps that investors should be looking also?
Yeah, so if people who are looking outside the U.S., China tech, I think, is a really prime area for investors, especially sort of the Magnificent Seven equivalent stocks in China. And here's why. I think we are sort of now realizing that sort of it's a tale of two worlds, and meaning there's going to be a bifurcation between Western tech and then China tech. But these names, one, just their size, their trading volume, sort of they separate from the pack. So these big names in China, these big tech names, are where there's an opportunity. To your point, the names had a huge rally. They have pulled back a bit. I think it could be a better time to step in, because really, although there's a ton of uncertainty what trade policy is going to look like, actually the path forward right now for China tech, some of its evaluation story is just a lot cleaner in the near term here than it is for U.S. tech.
Well, going back to U.S. tech then, Dave, we've got another name in the bunch with CoreWeave's IPO. How are you thinking about a name like CoreWeave and how it's been performing since going public?
Yeah, well, since going public, I think it's probably been a bit disappointing, or at least the sentiment that we can receive from how the IPO was priced. But I actually think, crazy to say, this is a sign that we're not really in a bubble behavior. And in bubble behavior, I think investors would have just totally bid up CoreWeave. They, of course, would have kind of been oversubscribed. We know that the price that came to market was probably closer to reality. Some folks are still concerned about the valuation there, but it did bring a lot of supply into the market that tech investors probably weren't necessarily prepared to handle because of that. But that's a name that I think firmly fits in the generative AI space, has sort of a strong bullish case for it. But in the near term, again, unless you have pretty strong hands, I think we're going to see a lot of volatility and uncertainty from AI names, from AI adjacent names, and sort of other areas, whether it's quantum computing, that are sort of connected to that trade, as investors just begin to really kind of take both their chips off the table and be a lot more cautious of where they're allocating.
Dave, I am curious, though, if there is any bigger read-through. I mean, you were talking about how you're optimistic around big tech earnings when they come. Any concern that something like CoreWeave or some of the analyst chatter that we've heard means that there's a possibility that some of these companies could say, maybe we're trimming our AI data center spending plans a little bit? Or do you think that they're really focused on the long term and that's not going to be a change?
Well, I actually think that the companies themselves, certainly there's chatter to your point, so I'm not going to poo-pah that statement, and that's the reality, because a lot of folks are certainly concerned about what the data center build-out is actually going to look like. I think the reason the stocks are actually under so much pressure is the companies themselves are seemingly going to continue to push forward with this long-term investment. It is an arms race to build up the requirements that's going to be needed for AI, large language models, in the future. And so right now, the hyperscalers and other companies are plowing CapEx into this space. I don't think that's going to change, barring sort of if we move from the vibe session to an actual recession. The challenge is investors are now weighing how much are they going to pay up for that spending when we're not seeing the ROI yet. To be fair, we were expecting to start seeing some ROI, particularly out of names like a ServiceNow or a Salesforce, who made really a big push into integrating AI into their platforms, helping which the goal of driving revenue at the top line. We're not seeing that yet. So as the sort of return on investment period gets pushed out, coupled with the unprecedented uncertainty that we're seeing from the political side of the political side of the house, it's difficult, I think, really to sort of make a hard case to keep paying up for a high multiple for growth that actually may be stagnant, even though high on a relative basis. So this sort of discomfort that we're seeing investors have toward tech, I actually think is rational for the time being, as we need to kind of see how these headlines shake out.
Yes, we do. Dave, thank you so much. Good to see you.
Thank you.